So this chapter is going to be on corporate formations and capital structure. Some of it should be stuff that you probably have talked about or learned about several times, just in general business classes. I'm sure you've talked about the difference between sole proprietorships, partnerships, LLCs, corporations. So we're going to talk more about those things from the standpoint of tax consequences of selecting any of those types of ways to form a business. But we'll also hit some of the general content areas within those. So of course here we've got your basic categories of various types of organizational forms for businesses: sole proprietorships, partnerships, corporations, limited liability companies, and limited liability partnerships. So each one of those has some unique features that make it more or less desirable for organizational purposes. None of them are perfect. It's all kind of situational as to which would be the best for whatever situation. So this is, sole proprietorships are obviously probably the least complicated version of a business organization, because basically if a person goes out and starts a business, they are automatically a sole proprietor. And then for income tax purposes, you'll fill out the Schedule C, of course, to show income and loss from the business, but there's no other entity involved. It still just basically consists of you. So anything that you see on the Schedule C just comes directly back to populate the rest of your 10. So the fact that it's so simple is one of the benefits of a sole proprietorship. The fact that it's not subject to double taxation is a benefit. And also the fact that business loss can offset other non-passive income within the owner's the owner of the business's other overall benefits. Of course, there are definitely some disadvantages of a sole proprietorship. These are the disadvantages from the tax perspective. Of course, one of the big disadvantages that we're not talking about here necessarily is just the fact that you're not shielded from liability. So that's one of the big reasons people turn away from being a sole proprietor. But you still have some of these other negatives as well related to taxes. You've got the fact that taxes or profits are currently taxed, even if they're left within the business. You're not, like a corporation, necessarily able to have fringe benefits that are non-taxable, at least some of them, and you have no option as to how you want to formulate your tax year, which may or partnership is more or less the functional equivalent of a sole proprietorship that has more than one person in it. It's the automatic go-to, okay, if we have two people forming a business or more and we do nothing else, bingo, we have a partnership. There's no requirements to fill anything else out necessarily in order to form. Obviously it complicates the matters that there's more than one person, so it's not just the extension of one person's taxes. So there is a tax return for partnership, but it basically is the form just divvies out and essentially assigns what you would normally see on a Schedule C, assigns it based on whatever the percentages of the ownership of the company are to the individual partners. So then the partners would basically take a K1 form, and that would be what they use to fill in the equivalent of what their Schedule C would have been if they were just. Like I said, in forming a partnership, there's not necessarily any forms or anything you need to fill out. However, oftentimes, as you see from this diagram, partner A contributes property or money, partner B contributes property or money, And you see in this instance, both receive a 50% interest. That's not always the case. Partner A could contribute much less property than the money that partner B contributes, and you could have an uneven partnership where partner B has 90% ownership of the partnership, and partner A has 10% ownership. But for the sake of simplicity, and unless noted otherwise, if you're looking at questions, generally you're going to divide it up proportionately. Okay, so here we move into a slight distinction between general partnerships and limited partnerships. And general partnerships is where everyone, one of the distinguishing characteristics is that each person within the partnership can have unlimited personal liability for all of partnership debts. Whereas limited partners, this is generally what happens is a limited partner contributes a certain amount of money, and they basically are hands-off partners where they just contribute the money, and then the general partners are the ones who are actually controlling the business. So because of that distinction, limited partners are generally only liable up to the amount of money that they contributed to the partnership. Whereas general partners could be, you could sue a partnership and the general partners could lose, all of their personal assets in the lawsuit, versus a limited partner would only be liable for whatever they contributed to the partnership. You see a lot of the same advantages of the partnerships that you do for sole proprietors. Basically, the advantages lie in the simplicity. You avoid double taxation, which is a plus. We talked a little bit in the last slide about liability. Again, similar to a sole proprietor, the fact that there is not essentially no shield, at least for general partners, in their liability. That's generally the big downfall of. Again, similar disadvantages that you see for partnerships versus sole proprietorships, and it makes sense that partnerships and sole proprietorships are very similar, because really the only main distinguishing characteristic is it's one person versus many, but it's the fallback category that you just automatically are a part of. So corporations, we've got our C Corps and our S corporations. C corporations are the ones that take a bunch of flack for the double taxation, because the C corporation as an entity itself is taxed, and then the owners of the C corporation are the shareholders, and for them to get any money back out of the corporation, it comes to them in the form of a dividend. And when it comes to them in that dividend, even though the organization itself has been taxed already, the dividend is taxed at the personal level as well. So that's, if you hear double taxation in corporations, that's generally what they're talking about. But the advantages, there's many advantages of the corporation, but one of them is the limited amount of liability that you can have. You're generally, in most cases, protected as far as your personal assets go. So you see down here with the S corporation, they have some of those liability benefits that you get from a C corporation, but for taxation purposes function very similar to partnerships or sole proprietorships, because the S corporation itself is not taxed. It's basically a pass-through entity where any income, profit, loss is passed through to whoever the actual owners are, so that you wait until you get to that individual level to taxation rules you're talking about. This is a fairly simple diagram showing, I'm not real sure what this is supposed to be showing. Just the fact that you have various shareholders. S corporations are limited in the number of shareholders they can have. C corporations are not, but shareholders are the owners of. Some characteristics of corporations that obviously we'll go into much further detail further on down the road. They have to file a Form 1120 for tax purposes. Dividends are taxed at a lower rate than ordinary income at the individual shareholder level. This is kind of a policy reason to try to adjust for the fact that the income is being taxed already at the corporate level. It's a possibility of getting a dividends received deduction for corporate shareholders. And of course, the worst part is that double taxation. Here are some of the tax benefits of a C corporation. I think generally these take a backseat to what the big benefit of a C corporation generally is the ability to raise capital through issuing stock. So that's generally, that combined with the liability issues are generally the reason that people will form as a C corporation. But you have all these other tax benefits that you may. Double taxation is the biggest, probably the biggest negative, period, within C corporation. But also definitely the biggest negative as far as the tax implications of formation go. Net operating loss and capital losses, that's another issue. And just the fact that you're never going to be able to use those at the shareholder individual level. Those will stay always at the corporate level and can only be used by the organization. S corporations have the advantages of being simple in taxation because they function like partnerships and sole proprietorships. Possibility to have a lower marginal rate than a C corporation. You can have non-passive losses that offset income on shareholders 1040, and income and deduction items retain their character when they're passed through to the individual. So whatever character they had at the S Corp level, they retain that same character as they are passed through. Of course, like I said, the biggest disadvantage of an S corporation, oh no, I was talking about the C corps, but there is no huge disadvantage of the S corporation from a tax perspective. The ones you see here are again very similar to what you would see in a partnership and a sole proprietorship. Limited number of shareholders limits the ability of the and there's not only a limited number, but there's specific requirements for those shareholders. So obviously you are more limited as an S corporation in the amount of capital and the way that you can generate that capital through issuing equity in your company. Limited liability companies again function very similarly to sole proprietorships or partnerships from a tax purpose. You do have the option of being treated when you have an LLC as a C corporation. But that is something that you would have to elect on your own. So the standard treatment is either if you have more than one member, partnership; if there's only one person, sole proprietorship for tax. Limited liability partnerships, again, very similar to normal partnership. These are kind of hybrid entities that some states allow to eliminate the total liability within general partnerships to kind of lessen that a little bit, but it maintains very similar tax treatment as a normal partnership. However, like an LLC, you can opt in to being treated from a tax perspective. And that brings us nicely to this next slide, because check the box regulations are basically the way that as a non-incorporated business, you can elect to be treated as either a partnership or a corporation by essentially checking the box on your forms, where this allows you to be treated. You have to file Form 8832 to elect this tax treatment. And here are some of the limitations as to when you can file and when you must file for it to take effect for any particular tax year. And then, of course, once you do make that election, you have to keep whatever you chose. Forming a corporation is going to vary state to state, but they are formed by filing certain documents with the Secretary of State in whichever state you are forming. Most states do not require an actual physical resident or actual physical operations within the state to file there. So, you see a lot of kind of forum shopping. For a long time, Delaware was the state that had the most favorable laws for corporations. So you saw many corporations, even though they had no presence in Delaware, filed and formed corporations under the laws of Delaware to receive the favorable treatment there. Generally, transfers of property are taxable to the shareholder to the extent of gain. And what we're basically talking about here is this section 351 I'm talking about. What this basically allows is it allows a taxpayer to transfer property to a corporation in exchange for stock, with the requirement that once the exchange is made, the person who traded the property for the stock or the group that traded the property for the stock must have control of the corporation after the exchange. And if those requirements are met, regardless of whether the transfer of property generated a gain or a loss, you don't have to recognize that gain or loss at that time. So basically, what this is doing is it's kind of saying the IRS is assuming, hey, because you transferred property or traded your property for stock in this corporation, and you now own a large majority, and I believe the number is 80% that is required to be considered in control of the corporation. So you basically own 80% of the corporation now. So since you own the corporation and you gave your property to the corporation, it's essentially recognizing the fact that yes, you gave property and received something in exchange, but what you received in exchange included possession or ownership of that property. So you are still, if not the actual owner, you are still kind of a secondary owner of the property that you traded. So that's why you get the deferral treatment if all of these are met. The shareholder takes a carryover basis from the property to the stock, and you basically calculate this by taking the fair market value of the property that was transferred, subtract any deferred gain or add any deferred loss, and that becomes your basis in the new stock in return for that property. Okay, and we'll go over some 351 transactions in class. So if and there are quite a few in the book. So if you read through the chapter, you should see examples. 351 property consists of money, installment obligations, accounts receivable, inventory, equipment, patents, or other intangibles. What's not considered property, and this is probably more important to know, services like accounting services, legal services, that type of thing. Indebtedness of the transferee not evidenced by security. So basically, you can't have like a verbal IOU that you're trading in exchange for property. Okay, I won't talk too much about this slide. Again, this is an example of when services are exchanged for. Okay, the control requirement, like I said, under 368C, control means 80%, basically 80% of all stock. So you have to have first, you have to meet both of these categories. You have to have 80% of any stock that has voting power and 80% of overall number of shares, whether that be non-voting or voting stock. So first look at the voting stock, you have 80% there, then add every share that's in the company together, see how many shares you have, do you have 80% there? Like I said, as far as the slideshow goes, I'm not going to go through too many examples here. If you want to take a look at this and make some sense out of it, you can. I think the better examples are explained in the book. And of course, we will work through. Well, Okay, transfers of both stock and property. If a transfer transfers both services and property, then the stock received counts towards the 80% control requirement. The property portion must be more than nominal value, which means at least 10% of the total fair market value of the property services contributed by that person. So basically, you can't just throw in a tiny bit of property that consists of like 1% of the transaction deal and have that count towards the property requirement. It has to make up a substantial portion of the. Another example there. Immediately after the exchange is the language used in determining whether you have control of the company in question. So basically, as soon as the transaction takes place, you have to have 80% control of all classes of stock. And what that also means here, if you look at this bottom bullet point, is not only do you have to have control immediately when this transaction goes down, but you also have to not have any preconceived plan that's already set in place to eliminate or to sell off a certain portion of your stock that takes you down below the 80% requirement. So if like you say, well, I need to have immediate control after this transaction, and then I'll sell you X number of shares a week later, if the IRS finds out that that deal was already in the works, and they may just assume it was if it takes place very close to the transaction date, they're going to come in and say, no, that was not a valid Section 351 transfer to begin with because you had this preconceived plan to sell, and therefore you did not meet the 80% control requirement immediately after. I just let you read through that slide. There's nothing I have really. Yeah, same there. Just read through that one. Add. Another example. This is kind of an important thing to look at here because this deals with disproportionate exchanges. So basically, if you contribute something and you get a bunch of stock in return and the deal is not fairly equal, the IRS can come in and say, hey, we're going to let you receive this 351 exchange for what we feel is the fair value of this property. However, we're going to look at the rest of this transaction. So let's say we are trading $20,000 worth of property for $500,000 worth of stock. Obviously, they're going to look at that and say, hey, that is not proportionate. Okay, so they may come in and say, yeah, you got a 351 transaction for this $20,000 worth of this stock. However, we're going to look at the remaining $480,000 worth of stock, and we're going to view that as a gift, or we're going to view that as kind of a separate transaction where you are taking this stock in a separate transaction. So, basically the idea here is if you have something so egregious that the IRS has no choice but to look at it and say there's no way that this is an arm's length transaction, and it just doesn't make sense economically, they have the ability to come in and recharacterize, and whatever scam you're trying to plan or whatever type of tax shield you're trying to create by doing it this way usually ends up blowing up in your face because the IRS has seen it before or is able to. So here's an example of a disproportionate exchange. You can nothing really to add to this one. Just, talking again about the control of the corporation was made. We talked about a little bit of these effects of 351 transfers on transferors. Here are some of the issues that you want to know or you should want to know when trying to characterize the effect on transfers. if there's a gain or loss realized, you have fair market value of the property contributed minus the adjusted basis. Gain must be recognized to the extent of the lesser of either fair market value of boot received or realized gain. So basically, and I don't think we talked about boot yet, but basically, usually what boot means in a tax scenario is cash. And that's usually what we're talking about when we talk about boot. But in this case, specifically, Section 351 essentially says that if in exchange for the property you're donating to the corporation, you get anything back that's not, more or less, anything that comes back to you that's not stock from that corporation is considered boot. Okay, so let's say that you contributed property and then you got some stock back and then you got what's considered boot in exchange. So what this is saying is any gain or loss, you first look at the overall value of the transaction and see, would you normally, assuming 351 didn't exist, would you normally recognize the gain or loss in this transaction? That's what this first bullet point shows us. And the next bullet point says, okay, so now take whatever you figured in that first bullet point, and if that is, if that gain is less than the fair market value of the boot received, then you are going to have to recognize that gain. If it's more than the fair market value of the boot that you received, then you only have to recognize up to the fair market value of the boot that you received. There you go. Basically, boot anything that's not stock in transferee. So you're going to calculate it differently for each piece of property transferred, and then you're going to divvy up the boot proportionately across the pieces of property. Built-in losses not. So this is going to be an important one because you're going to want to know your shareholders' basis, and that's the equation right there. Adjusted basis of the property transferred to the corporation. Add in any gain received, subtract out any fair market value of any boot received, and then subtract out any cash boot received. And then finally, subtract out any liabilities assumed by the new corporation, and you're left with the adjusted basis, new adjusted that you received. Here's an example. If you receive various classes of stock in exchange for your property transaction, you're basically going to look at the fair market value of the classes of stock that you received, and you're going to proportionally allocate whatever your basis is over those. So another important thing to look at is going to be the character of the gain, if you have to recognize the gain. And that character of the gain is going to depend entirely on the type of the underlying asset that's being transferred. So if you transfer inventory to the corporation, then the gain that you recognize is just considered ordinary income. Any type of equipment could be Section 1231 gain subject to depreciation recapture, which we talk about a little bit in individual income tax. Another part of the characteristic of the gain we want to look at for purposes of determining how to recognize gain or loss is going to be the holding period. So you're going to add any time that you held any piece of equipment that you transferred. So any time period that you held the equipment is added to the basis of the stock received in exchange for it. If you cash, boot, or inventory is treated as the holding period starts the day after the exchange. Here are some of the various issues that you would want to know about as how Section 351 affects transferees. So this would be the corporation receiving the property from the future shareholder that's going to receive stock. So this slide basically says, in the case of a 351 transfer, if all you're giving is to the shareholder is stock, you have no realized gain or loss. If you're transferring property to the shareholder, you're going to treat it as if it's been sold. And if there's any losses, we're not going to recognize them until the underlying property. Basis is going to be the fair market value of property received. If it's a taxable transaction to the transferor. If not, then you can as follows. You take the transferor's adjusted basis in property that's been transferred, add any gain recognized by the person transferring the property, and subtract any reduction for lost property. That becomes the corporation's basis. So the basis that the new company takes becomes important in determining the holding period of the equipment or property that's being received by the corporation. So if the new company takes the adjusted basis of the transferor, then they also take the holding period. It's called tacking. So it basically it tacks on whatever the holding period was in the hands of the individual before the property was transferred and adds that to the new holding period. And so if there was no Section 351 deferral, then we're just going to treat it as the holding period starting the day after the exchange. There's an example you can take a look at. Another example you can take a look at. Important point from this slide is this first bullet point here. If a shareholder transfers lost properties to a corporation, then the basis of the property must be reduced to fair market value. This is so that you're not sitting on a deferred loss and prevents, like it says there in the second bullet point, so if the adjusted basis is not reduced to the fair market value for any of these reasons we talk about here, then the holding period will tack again, like we talked about before. So one of the reasons that you could not reduce it is if the total fair market value of assets being transferred is greater than the total adjusted basis, then you don't have to have that reduction. Also, if this is applicable, if the shareholders elect, they can take a reduction in the basis before it transfers to the corporation instead of the corporation taking the adjustment in the basis. Take a look at this slide. I don't really have anything to add to. Same thing, just a continuation. Important to understand the calculation that goes into calculating the transferor's basis. Assuming new company assumes transferor's liabilities, the basis becomes the basis in the transferred asset plus cash transferred plus gain recognized, which would be any excess liabilities over the basis, minus the liabilities assumed by new company. So this is fairly, I don't want to say self-explanatory, but it should be at least evident that you're going to want to subtract out any liabilities that you assume because that rightly so should have an effect on your basis. Because if you didn't subtract that out when you went to sell that property in the future as well, you basically would have paid for that excess liability twice. And depreciation recapture is an issue or can be an issue within the Section 351. And we'll, I think, take a look at least one example of that in class. So we'll leave that for that time period. Okay, moving on to choice of capital structure. This is an important issue for a lot of corporations, deciding between financing their business with debt or with equity. So debt would obviously be essentially issuing bonds, which is similar to just taking out a loan, borrowing money for a set time period with a set interest rate in terms for paying it back, or selling ownership interest in the company through the issuance of stock, which obviously would be equity. So one of the big deciding factors, or one of the considerations at least, is if a shareholder contributes property exchange for stock, then it's a non-taxable transaction. So that benefits both the shareholder and the entity. If that same deal is made, but instead of receiving stock, the shareholder trades property for debt or in exchange or essentially as a loan, then it's considered boot and it becomes taxable. So that's an issue. Dividends are not deductible. Interest is deductible. So again, that's a consideration to take into consideration. And extinguishment of debt or cash on demand is something to take a look at as well. If a government or some other entity makes a contribution for whatever reason, policy or just makes sense for them business-wise to contribute to a corporation, Section 118 covers these corporations and can exclude them from taxable income if this contribution is of money or property by a non-shareholder, adjusted basis of assets used in that case. Here's an example of a Section 118 transfer that may occur, so take a look at that. If a stock or debt obligation becomes worthless, usually the holder of that stock or debt obligation can claim an ordinary loss. And the benefit of that is these ordinary losses are net operating losses that can be carried back 2 years and forward 20 years to offset other items of ordinary income. So obviously